Hi everyone, today's video is about methods that the federal government use to finance a deficit, which on the surface appears a pretty easy topic, but there's a couple of key areas you need to be aware of when learning this content. So for the first one, let's go into really what a deficit is, okay? And we've got some basic language here of receipts, which is the money that the government proposes to receive as a result of mainly taxation and other forms of revenue for the government. So we call them receipts. And then we take away the expenditure, the planned expenditure that the government is expecting to spend on the services that they want to provide for the economy and for the citizens. And don't forget, the budget as it's handed out each year really is just a plan of these two things. It's a plan of what the government plans to take in the form of money, and then what they plan to spend that on. And then the outcome of one minus the other is what we call the budget outcome. And the budget outcome can kind of be one of three things, two of which we're going to quickly talk about now. Okay, so let's just use a scenario here, and I'm obviously using really little numbers. Thankfully, the government receipts are much larger than $400, but let's just say in this particular example, the receipts that the government is planning to receive from its citizens and businesses is $400. So $400 of money in. And then they plan to spend $300 of money out. Well, then that's going to leave us with $100 left over, and we call that money left over a surplus, which is similar language to what we've used before earlier in the year. Surplus meaning more. And so we've got $100 more, of which the government can choose to do a number of things with. But that's not the focus of this video. Because there's another situation here where, let's say, there's also $400 of planned receipts, but then the government, for whatever reason, is deciding that they're going to spend $450. So they're spending $50 more than what they're bringing in, and then we call that a deficit. So where there's not enough money to cover all of the planned expenditure, we call that a deficit, and it's just the same calculation of receipts minus expenditure. All right, look out for these traps though, because what I'll often have students say is they're like, oh, okay, if the government's spending too much, well then just don't spend enough. Or just don't spend as much, I should say. So just spend $50 less and then you don't have to worry about it. But you've got to remember that the budget is a plan document of this is what we want to bring in as far as revenue, and this is what we want to spend. And if the net result of that is there's not enough money, well, the decisions on what they're going to tax and what they're going to bring on have already been made. So try and think of it like a line in the sand of what are we bringing in? What are we spending? Okay, what are we left with? Do we have too much money or not enough? And if we have enough money, if we don't have enough money, we can't just change the plan because the plan has kind of gotten us to in this situation. So don't forget, a deficit occurs when the planned expenditure exceeds receipts. And you can't finance a deficit. You can't finance this shortfall by changing the plan. That's not really what we're talking about here, because the government has made these decisions on what they want to receive in the form of taxation and what they want to spend in the form of expenditure for very good reasons, for the welfare of its citizens, for macroeconomic reasons to speed up or slow down the economy. So the receipts and expenditure, when you get to your budget outcome, stay. And then essentially the government has to make a decision on where they borrow their money from. This is the key idea of this particular key knowledge point. The three ways to finance a deficit are just three different ways that the government can borrow money. So let's go through them very, very briefly. So the first method to finance a deficit is to borrow from domestic investors. So domestic in the context of economics means Australian, since we are in Australia. And so one way the government can do that is they can borrow from domestic investors. And what does that look like? Well, they will sell a bond, which is kind of like an IOU. It's similar to a loan. It's not a loan, but let's just, for the purposes of today, just pretend in your mind it's kind of like a loan. It's a promise to pay it back into the future with a particular rate. So what the government will do is they will have essentially a piece of paper and they will say, this is an IOU. I mean, this is your textbook, but here is an IOU. I will sell this to you, domestic investor, whether that's a bank or an individual or an institution or whatever it might be. And in return, the government receives money. Okay, and in this example we use, they're going to do that for $50. They're going to sell $50 worth of bonds to domestic investors. So the piece of paper, essentially, the IOU, goes to the domestic investors. And then in return, the government gets the money that they are short, the $50 in this instance. Okay, so be really careful with your language of selling and buying bonds. The best way I like to think of it is that IOU document, actually visualize it as a piece of paper. And in order for the government to receive money in, well, the bond has to be sold in order for them to get that money. So try to just imagine it in that directional kind of thought experiment. So the bond is sold to domestic investors too. You can buy a government bond if you really want, and in a way you'll be financing the government deficit. But mainly institutions and banks will often be the main buyers of these government bonds. Then what happens as a result of this, and this is really important in your understanding of these, you need to know more than just the 3 different ways to finance a deficit. You need to know the consequences of them, because you're going to see in a little bit, the start bit at the top of this kind of flow, they're all pretty much the same, but the outcomes are different depending on which option that they choose. So the consequences here are important. And the reason why interest rates rise is this. Imagine you are the government, and they're not borrowing, by the way, $50. Well, they're not selling $50 worth of bonds. They're selling hundreds of millions of dollars worth of bonds. And so as a result of that, there is a finite supply of money available in the Australian cash market. So individuals and businesses and banks only have a fixed amount of cash that they can actually lend to the Australian government. And so when the big bad Australian government comes in and soaks up all of that money that was in the banks, that was in people's savings account, that was in businesses' bank accounts, well, there's less money available now to be traded in that particular market. Money is scarce now. And as we all should know by now, when something is more scarce, shortages occur, and to clear those shortages, the price of those things go up. And well, what's the price of cash? It's an interest rate, the price of borrowing money. And so by the government coming in here and engaging in the cash market, it has soaked up all of the cash available, thereby making it more scarce, making interest rates rise. The technical name for this is crowding out. The big bad government comes in and crowds out all of the other investors. And as a result of that, aggregate demand is going to fall, because as we will find out later in the year, when interest rates rise, it increases the price of borrowing money and it slows down aggregate demand. All right, so we're going to move on to the next one. The other way available to the government is they can borrow from overseas investors, and they're still going to sell bonds. So you can buy a government bond for a Swiss bank if you really want. That's absolutely fine. So in this case, the Australian government will sell a bond, this time to someone or an entity overseas. But in order for that to happen, well, the government will sell their bond to, let's say, a Swiss business. The bond will go over to the Swiss business person, but the person who has bought that bond can't then give their local currency back to the Australian government. And I probably should have chosen a different country than Switzerland. I'm pretty sure they've still got Swiss francs. Whatever the Switzerland currency is, that's no good to the Australian government, because they need Australian dollars in order to pay for the infrastructure projects, in order to pay for the public servants, and pay for the things that they were short in when they did their budget outcome. And so in order for this to be useful to the Australian government, that Swiss investor is going to have to convert their currency into Australian currency. And as we learnt in the last outcome, when the demand for Australian currency goes up, well, exchange rates are going to rise. Because these overseas investors are going to have to sell their currency and demand the Australian one, well, then there's less Australian currency floating around the international currency markets, and same scenario here. The price of the Australian dollar will now go up, and as we've learnt in the last outcome, this will result in a fall in aggregate demand, because our level of imports will rise relative to exports and vice versa. So you can start to see some patterns now. The first two are kind of similar. Who they sell to is different, but the effect on the overall economy at the end is the same, with a fall in aggregate demand. And then we've got our third one here, where the government can choose to borrow from the Reserve Bank of Australia. And again, the government can't just take money from the RBA, because they are separate entities. The government can sell bonds to the Reserve Bank of Australia, just like they did with the other two. It's just a different entity here who's buying that bond. Now, as a result of that, we're going to have high inflation, because it's introducing a whole lot of extra demand and cash into the Australian economy that wasn't there before, thereby driving up the price of things and worsening purchasing power of individuals. And what do you know? That's also going to create a fall in aggregate demand. And so when we look and summarize all three of these, the mechanism by which the government finances a deficit is roughly the same. Okay, that's this middle row in here with the selling of bonds. Who they sell the bonds to is different. The consequence of each of those three is different, but the end result is the same, being a fall in aggregate demand. And so when a government is choosing, when they're creating their budget, so whether their balance of receipts and expenditure, and if they're deciding here that they're going to have to run a budget deficit, well, then there's going to be detrimental impacts on the Australian economy, no matter which one they pick. And so quite often, if they do need to finance a deficit, the government will choose a selection of these three, rarely the RBA anymore. But the other two, they'll give a combination of these two options available to the government, depending on the current economic conditions. All right, so the key idea here is the mechanism, selling of bonds, is the same. The outcome, I won't do that finger, the outcome is the same as far as a fall in aggregate demand, but it's the consequences for each of these that are different, and it's really, really important that you not just remember these consequences, but you can explain them in a couple of steps. Hopefully that was helpful. Happy learning.